Every day, millions of traders wake up believing they understand the market. They've memorized candlestick patterns, they've studied support and resistance, they know their RSI from their MACD. But here's the brutal truth that will change everything. You're not seeing the market at all. You're seeing shadows on a cave wall while the real game plays out in dimensions you've never imagined. What if I told you that beneath every chart you've ever analyzed lies a hidden architecture, a skeleton so fundamental that once you see it, you can never unsee it. And once you understand it, trading transforms from gambling to reading. This is the story of market structure, not the kind they teach in textbooks, not the oversimplified version peddled in trading courses. This is the raw, unfiltered blueprint that institutions use to systematically extract wealth from retail traders who think they're playing the same game. You see, while you've been chasing breakouts and hunting for the perfect entry, smart money has been operating on an entirely different level. They don't predict where price will go. They engineer where it must go. They don't hope for favorable moves. They create the conditions that make those moves inevitable. And the language they speak? Structure. Pure, mathematical, undeniable structure. Think about your worst trades, the ones that still keep you awake at 3 in the morning. That perfect setup that instantly reversed. That breakout that became a breakdown. That support level that crumbled the moment you went long. You probably blame bad luck, market manipulation, algorithmic interference. But what if I told you there was a reason, a structural reason that was screaming at you from every angle, but you simply didn't know how to listen? Here's what separates the 5% who consistently profit from the 95% who consistently lose. The winners have learned to read the market's true intentions through its structural footprints. While the majority fights over scraps at obvious levels, the elite position themselves where the real money flows, where liquidity pools, where imbalances must be corrected. This isn't about finding another indicator. This isn't about discovering some secret strategy that Wall Street doesn't want you to know. This is about developing X-ray vision for markets, about seeing through the noise to the signal, about understanding that every single price movement, no matter how chaotic it appears, follows laws as rigid as physics. And just like physics, once you understand the laws, you can predict the outcomes with startling accuracy. But here's where it gets interesting. Market structure isn't just about technical analysis, it's about psychology. It's about understanding that behind every chart pattern is human behavior playing out at massive scale. Fear, greed, hope, desperation. These emotions create predictable footprints in price action, and those footprints form the very structure that governs every market move. The professionals know this. They've built their entire approach around reading these emotional signatures. While retail traders focus on entries and exits, institutions focus on where emotions will peak and how to position themselves accordingly. They don't fight the crowd, they use the crowd. Now, before we dive deeper into this rabbit hole, let me be crystal clear about something. What you're about to learn isn't financial advice. This is educational content designed to fundamentally shift how you perceive price movement. Your trading results will depend entirely on how you apply these concepts, your risk management discipline, and your ability to control your own emotional responses. Because here's the thing about seeing market structure clearly. It's both liberating and terrifying. Liberating because you finally understand why price moves the way it does. Terrifying because you realize how blind you've been, how many opportunities you've missed, how many traps you've walked into with your eyes wide shut. But that's exactly why this matters, because every trader who's ever achieved consistent profitability has gone through this same awakening, this same moment of clarity where the market stops looking random and starts revealing its true nature. So let's begin with the foundation, the bedrock principle that everything else builds upon. Market structure is not about lines on a chart. It's not about trend channels or Fibonacci levels. Market structure is about flow. The flow of capital, the flow of sentiment, the flow of information, and most importantly, the flow of liquidity. Picture the market as a river. On the surface, you see waves, ripples, foam. That's what most traders focus on. The moment-to-moment price action, the candle-by-candle movement. But beneath the surface runs the current, deep, powerful, invisible to those who only look at the waves. That current is structure, and it determines where every drop of water will ultimately flow. When you learn to read structure, you stop being surprised by price movements. You stop asking, why did that happen, and start asking, where will the flow take us next? Because structure doesn't just show you what happened, it shows you what must happen next. Think about this. Every market participant, from the smallest retail trader to the largest institutional fund, leaves traces in the price action, their entries, their exits, their stop losses, their profit targets. All of this creates patterns, predictable, repeatable patterns that form the skeleton of market movement. But here's where it gets really powerful. These patterns exist across all time frames. What you see on a 1-minute chart is a fractal reflection of what's happening on the daily chart. The same structural principles that govern a 5-minute scalp trade also govern a 6-month position trade. The scale changes, but the underlying architecture remains constant. This is why retail traders struggle so much with time frame analysis. They treat each chart as if it exists in isolation. But professionals see the connections. They understand that a breakout on the 15-minute chart might just be a retracement on the 4-hour chart. They know that what looks like a reversal on the 1-hour might be continuation on the daily. And this brings us to the first major revelation about market structure. Context is everything. A pattern that signals opportunity in one context might signal danger in another. The same technical setup that prints money during trending conditions might destroy your account in choppy markets. This is why mechanical trading systems fail so consistently. They try to apply rigid rules to a dynamic environment, but structure is fluid. It adapts. It evolves. And if you want to trade it successfully, you must learn to adapt and evolve with it. Now let's talk about something that will probably make you uncomfortable. Most of what you've learned about support and resistance is incomplete. Those horizontal lines you draw on your charts, they're not wrong, but they're only showing you one dimension of a multidimensional game. True structural levels aren't just about where price has bounced before. They're about where liquidity congregates, where orders cluster, where the majority of market participants have placed their bets. And smart money? They know exactly where these clusters exist. They hunt them systematically. This is the predator-prey dynamic that governs all markets. Retail traders, with their obvious stop losses and predictable profit targets, become the prey. Institutions, with their deep pockets and structural awareness, become the predators. They don't compete with retail traders, they feed on them. But once you understand this dynamic, something remarkable happens. You stop being prey. You start thinking like a predator, not in a malicious way, but in a strategic way. You begin to see where the crowd is positioned, where they're vulnerable, where their emotional breaking points lie. And that's when trading becomes less about hope and more about probability, less about prediction and more about positioning, less about being right and more about being smart. This shift in perspective is crucial because it addresses the fundamental flaw in most retail trading approaches: the obsession with being right. Retail traders want to predict the future. They want to call tops and bottoms. They want to be the genius who saw it coming. But professionals, they don't care about being right. They care about being profitable. They understand that the market will tell them what it wants to do. Their job isn't to predict. Their job is to listen, to respond, to position themselves where probability favors them, regardless of what actually happens next. This is the mindset shift that separates profitable traders from the rest. It's not about having better analysis. It's about having better perspective, about understanding that the market is not something to conquer, but something to dance with. And the music you dance to, that's structure, the rhythm that guides every step, the beat that never lies, the melody that reveals itself only to those who know how to listen. As we continue this journey together, you're going to learn to hear that music, to feel that rhythm, to understand the language that institutions speak fluently but retail traders barely comprehend. You're going to discover why some patterns work and others fail, why some breakouts continue and others reverse, why some support levels hold and others collapse. But more than that, you're going to develop something invaluable: market intuition. Not the mystical kind based on feelings and hunches, the mathematical kind based on probability and structure, the kind that comes from understanding the mechanical principles that govern price movement. Because at its core, that's what market structure really is. It's the physics of price, the laws that govern how capital flows, how emotions manifest in charts, and how opportunities are created and destroyed. And these laws, once understood, become your compass in the chaos, your North Star when everyone else is lost in the fog of conflicting signals and market noise. But here's what most traders don't realize. The market has been teaching you these laws all along. Every losing trade, every missed opportunity, every moment of confusion, they were all lessons in disguise. The problem is, most traders never learn to interpret the lessons. They experience the pain but miss the wisdom. They feel the frustration but ignore the feedback. They blame external forces when the real answers are hidden in plain sight, embedded in the very structure they've been staring at for years. Let me paint you a picture that will change how you see every chart for the rest of your trading career. Imagine you're watching a soccer match, but instead of seeing the players, you can only see the ball. It moves left, right, forward, backward. Sometimes it seems random, sometimes it follows patterns. But without seeing the players, without understanding their strategies, their formations, their intentions, you're just watching a ball bounce around a field. That's exactly what most traders are doing. They're watching the ball, the price action, without seeing the players, the institutional flow, the liquidity dynamics, the structural forces that actually control where that ball goes next. But what if you could suddenly see the players? What if you could understand their game plan? What if you could anticipate their next move based on their current formation? That's what structural analysis gives you. Vision, clarity, the ability to see the game within the game. Now here's where this gets personal. I want you to think about your last 10 trades, not the winners that made you feel like a genius, the losers, the ones that hurt, the ones that made no sense, the ones where you followed your analysis perfectly but still got crushed. In every single one of those trades, I guarantee you there were structural clues you missed. Warning signs written in the language you didn't yet speak. Red flags waving frantically while you focused on the green candles that ultimately betrayed you. This isn't about beating yourself up, it's about awakening to possibility. Because those same clues that could have saved you from disaster, they're still there. They're still speaking. They're just waiting for you to learn their language. And that language has vocabulary, specific terms that describe specific phenomena. But unlike the jargon that gets thrown around in trading education, these terms represent real, measurable, tradable concepts. When institutions talk about liquidity sweeps, they're not using fancy terminology to sound smart. They're describing a specific mechanical process where price temporarily extends beyond obvious levels to trigger stop losses and provide the liquidity needed for larger moves in the opposite direction. When they discuss order blocks, they're not pointing to arbitrary rectangles on a chart. They're identifying zones where significant institutional activity occurred, areas where large players built or reduced positions, creating imbalances that future price action must eventually address. When they analyze break of structure, they're not just noting that price moved beyond a previous high or low. They're recognizing a fundamental shift in the underlying dynamics, a change in the character of the market that signals new opportunities or warns of new dangers. These aren't abstract concepts. They're concrete realities that play out thousands of times every day across every liquid market in the world. And once you start seeing them, you realize something profound. The market isn't random at all. It's incredibly organized. It's following rules so consistent they might as well be laws of nature. But here's the catch. These rules aren't taught in business schools. They're not covered in traditional technical analysis courses. They're not explained in the trading books that line the shelves of every aspiring trader's library. Why? Because they represent the real edge, the actual advantage that separates those who consistently extract money from markets from those who consistently donate it. And those who possess this edge have little incentive to share it widely. Think about it logically. If everyone understood how institutional players really operate, if everyone could read the structural signals that telegraph major moves, if everyone knew where liquidity pools and how to position around them, would the edge still exist? Of course not. Edges exist precisely because they're not widely understood. They persist because the majority remains focused on the surface while the minority penetrates to the core. But here's what's beautiful about structural analysis. It's not a secret system that can be gate-kept forever. It's a skill set, a way of seeing, a form of market literacy that once developed becomes as natural as reading words on a page. And just like learning to read, there's a progression. First comes recognition, learning to identify the basic building blocks, then comes comprehension, understanding what those building blocks mean when they combine in different ways. Finally comes fluency, the ability to read the market's intentions as easily as you read this sentence. That fluency doesn't happen overnight. It's earned through observation, practice, and yes, mistakes. Lots of mistakes, because every mistake contains information. Every loss teaches a lesson. Every moment of confusion reveals another piece of the puzzle. The difference between traders who eventually succeed and those who eventually quit isn't talent. It isn't luck. It isn't access to better information or superior technology. It's persistence in the face of complexity. The willingness to keep learning when learning is hard. The commitment to developing new skills when old approaches stop working. Because here's something they don't tell you in those motivational trading videos. Becoming consistently profitable is not just about finding the right strategy. It's about becoming the right trader. And becoming the right trader requires confronting uncomfortable truths about how markets really work. Truth number one, the market doesn't care about your analysis. It doesn't matter how many hours you spent drawing trend lines or calculating pivot points. The market moves based on supply and demand dynamics that exist at levels far deeper than your technical indicators can measure. Truth number two, most retail trading approaches are designed to fail. Not by conspiracy, but by structure. They focus on the wrong time frames, emphasize the wrong signals, and ignore the forces that actually drive price movement. Truth number three, consistent profitability requires thinking like an institution, not like a retail trader. This means longer time horizons, deeper analysis, and most importantly, understanding that your individual trades are just tiny pieces of much larger games. These truths can be difficult to accept because they challenge fundamental assumptions about how trading works. They force you to question everything you've learned and start over with a beginner's mind. But that beginner's mind is exactly what you need, because the moment you think you understand markets completely is the moment markets will humble you completely. The market is always evolving, always adapting, always finding new ways to transfer money from the confident to the patient. And patience, as you're about to discover, isn't just a virtue in trading, it's a strategy, a competitive advantage, a way of positioning yourself where time works for you instead of against you. Because while retail traders rush to catch every move, institutional players wait for the moves that matter. While retail traders trade their emotions, institutions trade the emotions of others. While retail traders hope for the best, institutions prepare for multiple scenarios and profit, regardless of which one unfolds. This is the institutional mindset, and developing it requires more than just learning new techniques. It requires rewiring how you think about risk, reward, and probability. It requires understanding that trading isn't about being right or wrong. It's about being positioned correctly when reality reveals itself. And reality, as you'll soon discover, has a structure all its own. That reality begins with understanding what most traders mistake for random noise is actually the market's clearest communication. Every spike, every rejection, every moment of hesitation carries meaning. But that meaning only reveals itself when you know how to decode the structural messages embedded within seemingly chaotic price movement. Let me show you something that will fundamentally alter how you perceive every chart you encounter. Right now, as you're watching this, thousands of algorithms are scanning markets for specific structural patterns, not the ones taught in retail trading courses, the ones that signal genuine shifts in market dynamics. These algorithms don't guess, they don't hope. They calculate probabilities based on structural mathematics that most traders never even realize exists. When price approaches a significant level, these systems aren't just looking at that level in isolation. They're analyzing the entire structural context. How did price arrive at this level? What happened the last 3 times it was tested? Where are the obvious stop losses clustered? What's the liquidity profile above and below? What's the institutional positioning based on commitment of traders' data? This is multidimensional analysis, and it's why mechanical retail approaches fail so consistently. They're operating in 2 dimensions while the real game happens in 4, 5, sometimes 6 dimensions simultaneously. But here's what's fascinating about structural analysis. Once you understand the principles, you don't need complex algorithms to see what's happening. The human eye, trained to recognize structural patterns, can process market information in ways that pure computation cannot. You develop intuition. Not mystical intuition based on feelings, but mathematical intuition based on pattern recognition refined through thousands of hours of observation. Think about a master chess player analyzing a position. They don't calculate every possible move. They see patterns. They recognize formations. They understand which pieces are strong and which are weak based on their position relative to the entire board. That's exactly how expert traders read market structure. The difference is, in chess, both players see the same board. In markets, most participants are playing blind. They see individual pieces but miss the larger formation. They focus on the move they want to make instead of the move the position demands. And positions in markets, just like in chess, have their own logic, their own requirements, their own inevitable conclusions if played correctly. When you learn to read these positions structurally, something remarkable happens. You stop fighting the market and start flowing with it. This flow state is where consistent profitability lives, not in perfect predictions or flawless executions, but in deep alignment with structural momentum. When you're flowing with structure, losing trades don't devastate you because you understand they're part of the process. Winning trades don't intoxicate you because you know they're the natural result of proper positioning. But achieving this flow requires confronting something most traders desperately want to avoid: the reality that markets are designed to be challenging, not unfairly challenging, mathematically challenging. They must be, because if they were easy, everyone would win, which is structurally impossible in a zero-sum environment. The challenge isn't random, though. It follows patterns, predictable patterns that repeat across all time frames and all market conditions. These patterns exist because human psychology doesn't change. Fear and greed manifest the same way today as they did 50 years ago. The technology changes, the speed changes, but the underlying emotional dynamics remain constant. And those emotional dynamics create structural footprints that trained eyes can read like fingerprints at a crime scene. When fear peaks, it leaves specific signatures in price action. When greed dominates, it creates different but equally recognizable patterns. When uncertainty prevails, the structural evidence is unmistakable to those who know what to look for. This is why technical analysis works when applied correctly, but fails when applied mechanically. The patterns themselves aren't magic, they're statistical representations of human behavior under stress. They work because people are predictable in aggregate, even when individuals are completely unpredictable. But here's where most traders go wrong. They try to trade individual patterns instead of structural contexts. They see a hammer candle and think bullish reversal without considering where that hammer formed, what led to its formation, or what structural elements need to align for the reversal to actually materialize. Context, as I mentioned earlier, is everything. A hammer at the bottom of a structural downtrend after a massive volume spike might indeed signal reversal. But a hammer in the middle of a range after low volume grinding is probably just noise. Same pattern, completely different structural implications. This is why backtesting individual patterns produces such inconsistent results. The pattern alone doesn't contain enough information. You need the structural context, the narrative, the story that price action is telling through its sequence of highs, lows, and transitions between them. And every market tells its story differently. Forex moves differently than crypto. Crypto moves differently than stocks. Stocks move differently than commodities. Not because they follow different rules, but because they're influenced by different structural forces operating at different speeds with different participants. Understanding these differences isn't just academic knowledge. It's practical wisdom that determines whether your analysis translates into profitable trades. A structural pattern that works beautifully in Forex might be completely unreliable in crypto due to differences in liquidity, participant behavior, and market microstructure. This is why successful traders often specialize, not because they can't understand other markets, but because deep structural knowledge of one market is more valuable than surface knowledge of many markets. When you truly understand how your chosen market breathes, how it reacts to different stimuli, how its participants behave under various conditions, you develop an edge that can't be replicated by someone jumping between markets randomly. But specialization doesn't mean isolation. The structural principles we're discussing apply universally. Once you master them in one market, you can adapt them to others with proper observation and adjustment for market-specific characteristics. The key is developing what I call structural literacy, the ability to read price action like a language, to understand that every movement has meaning, every pause has purpose, every acceleration has cause. Nothing in markets happens randomly, even when it appears completely chaotic. This literacy develops gradually through deliberate practice. You start by learning to identify basic structural elements. Then you progress to understanding how these elements combine to create larger patterns. Finally, you reach the level where you can read the market's intentions in real time, adjusting your analysis as new information becomes available. At this advanced level, trading becomes less about prediction and more about adaptation. You develop hypotheses based on structural analysis, but you remain flexible enough to change those hypotheses when the structure changes. You trade probabilities, not certainties. You position for likely outcomes while remaining prepared for unlikely ones. This adaptability is crucial because markets are not static systems. They evolve constantly as new participants enter, as technology advances, as economic conditions shift, as regulatory environments change. What worked last year might not work this year. What works in trending markets might fail in ranging markets. But structural principles endure because they're based on fundamental aspects of human nature that don't change. Fear still causes selling. Greed still drives buying. Uncertainty still creates volatility. Hope still leads to disappointment. These emotional constants create structural constants that persist across all market conditions. The challenge is learning to recognize these constants amid the chaos of daily price movement. It's like learning to hear a specific conversation in a crowded restaurant. At first, everything sounds like noise, but as you train your ear, individual voices become distinct. Separate conversations become clear. The noise transforms into information. This transformation doesn't happen through wishful thinking or positive visualization. It happens through focused observation combined with structured learning. You need to understand what you're looking for before you can recognize it when it appears. You need frameworks for organizing market information before that information becomes useful for trading decisions. And the most powerful framework for organizing market information is structural analysis. Not because it's the only valid approach, but because it addresses the root causes of price movement rather than just the symptoms. Instead of asking what happened, structural analysis asks why did it happen and what does it mean for what happens next. This cause and effect thinking is what separates systematic traders from reactive traders. Systematic traders see events in sequence. They understand that today's price action is influenced by yesterday's structure and will influence tomorrow's opportunities. Reactive traders see each moment in isolation, missing the connections that create genuine edge. Those connections exist at multiple levels simultaneously. Short-term structural patterns nested within intermediate-term patterns nested within long-term patterns. Each level provides context for the others. Each level offers different types of trading opportunities. Each level requires different analytical tools and different risk management approaches. Most retail traders focus exclusively on short-term patterns because they want immediate gratification. They want to be right today, this hour, this minute. But the most reliable edges often exist at the intersection of multiple time frames, where short-term patterns align with intermediate-term structure and confirm long-term directional bias. This multi-time frame thinking requires patience that most traders lack. It requires the discipline to wait for optimal setups instead of trading every minor fluctuation. It requires the wisdom to understand that the best trades are often the ones you don't take. But when you do find these multi-time frame alignments, when structure confirms at multiple levels simultaneously, the probability of success increases dramatically. Not to 100% because nothing in trading is certain, but to levels that make consistent profitability not just possible, but probable for those who maintain proper risk management discipline. Risk management, of course, is its own form of structural analysis. It's about understanding the mathematical relationships between position size, stop-loss placement, and account preservation. It's about recognizing that no single trade, no matter how perfect it looks, should threaten your ability to continue trading. This is where many otherwise skilled traders fail. They develop excellent analytical abilities but poor risk management habits. They can read structure beautifully but size their positions emotionally. They understand probability but act as if certainty exists. The cruel irony is that emotional position sizing often leads to being stopped out of good trades just before they work. You risk too much. Fear kicks in, you exit prematurely, then watch in frustration as your analysis proves correct after you're no longer involved. This cycle destroys more trading careers than bad analysis ever could. Breaking this cycle requires treating risk management as seriously as market analysis. It requires understanding that position sizing isn't about maximizing profits on individual trades. It's about optimizing long-term performance across series of trades. It's about ensuring that inevitable losing streaks don't destroy your capital base. And losing streaks are inevitable, even with perfect structural analysis. Markets go through periods where structure becomes temporarily unreliable, where normal patterns fail, where the unexpected becomes routine. These periods test every trader's resolve and separate those who trade for excitement from those who trade for profit. The traders who survive these challenging periods aren't necessarily the ones with the best analysis. They're the ones with the strongest foundation, the most robust risk management systems, the deepest understanding of market cycles, the patience to wait for favorable conditions to return. Because favorable conditions always return. Markets are cyclical by nature. Periods of clarity follow periods of confusion. Trending phases follow ranging phases. High volatility follows low volatility. These cycles create opportunities for those positioned to capitalize on them and challenges for those caught unprepared. Understanding these cycles is another dimension of structural analysis. Not just reading individual patterns, but recognizing what type of market environment you're operating within and adjusting your approach accordingly. Some strategies work beautifully in trending markets but lose money consistently in choppy conditions. Other approaches profit from volatility but struggle when markets move smoothly. The key is developing a toolkit of strategies suited to different structural environments and the wisdom to know which tool to use when. This requires honest assessment of current market conditions rather than wishful thinking about the conditions you prefer to trade. Most traders have favorite market conditions. They love breakouts or reversals or trends or ranges. But markets don't care about your preferences. They present whatever conditions serve their structural needs at any given moment. Your job as a trader is to adapt to these conditions, not to demand that they adapt to you. This adaptability mindset extends beyond strategy selection to include psychological flexibility. The emotional skills needed for trend following differ from those required for range trading. The patience needed for position trading differs from the intensity required for scalping. The confidence needed for breakout trading differs from the contrarian thinking required for reversal trading. Developing this psychological flexibility takes time and conscious effort. You must observe not just how markets behave in different conditions, but how you behave in different conditions. What brings out your best trading? What triggers your worst habits? What market environments align with your natural psychological tendencies? These questions don't have universal answers because every trader is different. But they do have personal answers that become clearer through honest self-observation, combined with systematic record-keeping. Your trading journal becomes a mirror reflecting both your analytical development and your psychological evolution. And that evolution never stops. Markets evolve, so traders must evolve. New patterns emerge as old ones stop working. New technologies create new opportunities while eliminating others. New participants enter markets with different objectives and different behaviors. Staying ahead of these changes requires commitment to continuous learning. Not just learning new techniques, but understanding why those techniques work and when they might stop working. not just following the latest trends, but recognizing which trends represent genuine evolution versus temporary fashion. This is the difference between traders who build lasting careers and those who experience brief periods of success, followed by long stretches of struggle. Lasting success comes from understanding principles, not just memorizing patterns, from developing skills, not just following systems, from building wisdom, not just accumulating knowledge. And wisdom, in trading as in life, comes primarily from experience, from making mistakes and learning from them, from facing uncertainty and developing comfort with ambiguity, from accepting losses gracefully and managing wins responsibly. The market is perhaps the most efficient teacher of these lessons because it provides immediate, objective feedback. You can't argue with profits and losses. You can't rationalize away mathematical results. You can't blame others when your own decisions determine your outcomes. This brutal honesty is simultaneously trading's greatest challenge and its greatest gift. Challenge because it forces you to confront uncomfortable truths about your decision-making abilities. Gift because it provides a clear path for improvement based on measurable results rather than subjective opinions. But improvement requires more than just recognizing what went wrong. It requires understanding why it went wrong and developing systems to prevent similar mistakes in the future. This is where structural analysis becomes not just a market tool, but a personal development tool. By learning to read market structure, you also learn to read the structure of your own behavior. You begin to see patterns in your decision-making. You recognize the conditions that bring out your best judgment and those that trigger your worst impulses. You develop strategies for managing your own psychology just as systematically as you analyze price movements. This integration of market analysis and self-analysis is where true trading mastery begins. Because ultimately, you're not just trading markets. You're trading your understanding of markets filtered through your own psychological framework. The better you understand both components of this equation, the more consistent your results become. And this brings us to a revelation that will fundamentally shift how you approach every trading decision. The market operates on multiple layers of structure simultaneously, each one influencing the others in ways that create what I call structural harmony or structural discord. Think of it like a symphony orchestra. Each instrument section represents a different time frame. The bass section provides the foundational rhythm. That's your weekly and monthly charts establishing the primary trend. The strings carry the melody, your daily charts showing the intermediate direction. The woodwinds add texture, your 4-hour charts revealing swing patterns. And the brass provides punctuation, your lower time frames marking entry and exit points. When all sections play in harmony, the music is beautiful and predictable. But when they're out of sync, when the bass is playing one rhythm while the strings follow another, chaos emerges. Most traders get caught in this chaos because they're listening to just one instrument while ignoring the full orchestra. Here's where most educational content stops. They'll tell you to use multiple time frames, but they won't tell you how these time frames actually interact with each other. They won't explain why a perfect setup on the 15-minute chart can fail spectacularly if the 4-hour structure is fighting against it. The secret lies in understanding what I call structural momentum. This isn't the momentum you see in your oscillators. This is the underlying force that determines whether price movements will continue or reverse. It's created by the alignment or misalignment of structural elements across multiple dimensions of market analysis. When structural momentum builds in one direction, it creates what institutions call conviction moves. These are the trades that work immediately and continue working. The ones where you enter and price moves in your favor without hesitation. Where your stop loss never gets tested and your profit targets get hit ahead of schedule. But when structural momentum is absent or conflicted, even technically perfect setups become grinding, frustrating experiences. Price moves toward your target, then reverses, moves back toward your entry, then bounces, creates the kind of whipsaw action that destroys both accounts and confidence. The difference isn't luck. It's not market manipulation. It's structural momentum either supporting or opposing your position. And learning to identify this momentum before you risk capital is perhaps the most valuable skill you can develop as a trader. Let me give you a specific example that will crystallize this concept. Imagine you're analyzing EUR USD on a Tuesday morning. The weekly chart shows a clear uptrend with higher highs and higher lows intact. The daily chart just broke above a key resistance level with strong volume. The 4-hour chart is forming a bullish flag pattern after the breakout. And the 1-hour chart is showing a textbook pullback to the breakout level. Every time frame is telling the same story. Every piece of structure is aligned. The structural momentum is clearly bullish. When you enter long on that 1-hour pullback, you're not just trading a pattern. You're trading the combined force of multiple structural elements, all pushing in the same direction. Compare that to a different scenario. The weekly chart is in a downtrend. The daily chart just failed at a key resistance level. The 4-hour chart is showing lower highs and lower lows. But the 1-hour chart has a nice-looking hammer candle at what appears to be support. Same hammer pattern, same technical appearance, but the structural momentum is overwhelmingly bearish. Every higher time frame is fighting against your long position. You're not trading with structural force, you're trading against it. This is why pattern-based trading systems produce such inconsistent results. They focus on individual formations while ignoring the structural context that determines whether those formations will actually work. It's like trying to swim upstream. You might make progress occasionally, but you're fighting the current instead of using it. But here's where this concept becomes really powerful. Once you understand structural momentum, you can use it to filter opportunities with surgical precision. You stop taking every setup that looks good in isolation and start taking only those setups that have structural wind at their backs. This filtering process eliminates probably 60 to 70% of potential trades. And for most traders, that feels wrong. They think more opportunities equals more profit. But the opposite is true. Fewer, higher quality opportunities almost always produce better results than numerous mediocre ones. Why? Because when structural momentum supports your position, you can hold longer and capture bigger moves. You can size larger because your probability of success is higher. You can sleep better at night because the entire structural environment is working in your favor rather than against it. This is how institutional traders think. They don't chase every minor fluctuation. They wait for structural alignment. They position themselves where multiple time frames agree and where the path of least resistance clearly favors their direction. Then they commit significant capital because the odds are overwhelmingly in their favor. Now let me introduce you to something that will revolutionize how you read price action, the concept of structural fracture points. These are specific areas on the chart where structural momentum can shift rapidly and dramatically. They're like fault lines in geology, invisible until pressure builds beyond their capacity to contain it. These fracture points exist at confluences of multiple structural elements, where major trend lines intersect with significant support or resistance levels, where Fibonacci retracements align with previous swing points, where round numbers coincide with institutional order flow levels. Most traders see these confluences as stronger support or resistance, which they often are. But what they miss is the flip side. When these confluences break, they often break catastrophically. The same structural forces that made them strong support become powerful momentum drivers in the opposite direction. Think about a dam holding back a massive reservoir of water. The dam is incredibly strong until it reaches its breaking point. But once that point is exceeded, the failure is sudden, complete, and unstoppable. The same water that was contained becomes a destructive force flowing in the opposite direction. Structural fracture points work the same way. They contain price movement until critical mass is reached. Then they unleash momentum that can drive sustained moves far beyond what normal technical analysis would suggest is possible. Learning to identify these fracture points and position yourself accordingly is like having a geological survey map for market movements. You know where the fault lines exist, you can see when pressure is building, and you can position yourself to profit from the eventual structural failure rather than being caught off guard by it. But identifying fracture points requires more than just drawing lines on charts. It requires understanding the psychology behind those lines. Why did price respect this level multiple times in the past? What kind of orders are likely clustered around it now? What would have to happen for those orders to be overwhelmed? This is where the human element of market analysis becomes crucial. Behind every structural level are human decisions, fear-based decisions, greed-based decisions, hope-based decisions, and human decisions, while individually unpredictable, follow statistical patterns when aggregated across large populations. When you understand these psychological patterns, you can anticipate how groups of traders will likely behave at key structural levels. You can predict where they'll place their stops, where they'll take profits, where they'll add to positions, and most importantly, where they'll panic. Panic is the fuel that powers the most explosive market moves. It's what transforms ordinary breakouts into momentum surges that continue far beyond rational expectations. It's what creates the kinds of moves that generate life-changing profits for those positioned correctly and devastating losses for those caught on the wrong side. The key insight is this: panic doesn't happen randomly. It happens at predictable structural locations under specific conditions. When you learn to recognize these conditions developing, you can position yourself to profit from the panic rather than being victimized by it. This is perhaps the darkest truth about market structure. Your profits often come from other people's emotional mistakes. Not because you're trying to hurt anyone, but because emotional decision-making creates the very inefficiencies that generate trading opportunities. When fear causes someone to sell at the bottom of a range, that creates the buying opportunity that allows you to profit from the eventual bounce. When greed causes someone to chase a breakout at the top of a move, that creates the liquidity that institutions use to exit their positions at optimal prices. This isn't exploitation, it's the natural function of markets. Emotional decisions create price distortions. Rational decisions correct those distortions. The profits flow to those who can remain rational when others become emotional. But maintaining that rationality requires more than just understanding market structure. It requires understanding your own psychological structure, the patterns of thinking and feeling that influence your decision-making under stress, the biases that cloud your judgment when money is at risk, the emotional triggers that cause you to deviate from your analytical conclusions. This is where trading becomes as much about self-mastery as market mastery. Because you can have perfect structural analysis, but if you can't execute that analysis consistently under pressure, it's worthless. The market doesn't care about what you know, it only cares about what you do. And what you do is determined not just by your knowledge, but by your emotional state when you apply that knowledge. Fear can cause you to exit winning positions too early. Greed can cause you to hold losing positions too long. Hope can cause you to ignore obvious warning signs. Desperation can cause you to take trades that violate every rule in your system. The solution isn't to eliminate these emotions. That's impossible. The solution is to structure your trading approach in ways that minimize their impact on your decision-making, to create systems and processes that guide correct behavior, even when your emotions are pushing you toward incorrect behavior. This is why the most successful traders rely heavily on predetermined rules and mechanical execution. Not because they lack intuition or creativity, but because they understand that discretionary decisions made under emotional stress are usually wrong. The time for creativity is during analysis and planning. The time for mechanical execution is during trade management. But even mechanical systems require human judgment about when to apply them and when to stand aside. Markets go through periods where even the best systems produce poor results. Recognizing these periods and adjusting your approach accordingly is itself a form of structural analysis. You're analyzing the structure of your own system's performance relative to changing market conditions. You're identifying the environmental factors that support your edge and those that undermine it. You're learning to trade your system as intelligently as you trade the markets. This meta-level analysis is where truly advanced trading begins. It's where you stop being a mechanical executor of predetermined rules and start becoming a strategic decision-maker who understands when to apply which tools under which conditions. At this level, you're not just reading market structure, you're reading the structure of your own trading process and continuously optimizing it based on changing conditions and evolving understanding. You become your own trading coach, constantly analyzing your performance and identifying areas for improvement. This might sound overwhelming, but it's actually liberating, because once you understand that trading mastery is a process of continuous refinement rather than a destination you reach, you stop putting pressure on yourself to be perfect immediately. You start focusing on gradual improvement rather than instant gratification. And that shift in focus changes everything. It makes losses educational rather than devastating. It makes winning streaks informative rather than intoxicating. It transforms trading from an emotional roller coaster into a systematic business process. But systematic doesn't mean boring. The markets provide endless intellectual challenges and opportunities for creative problem solving. Every changing condition presents new puzzles to solve. Every failed trade provides new data to analyze. Every successful campaign reveals new patterns to explore. The key is approaching these challenges with the right mindset, not as a gambler seeking excitement, but as a business person seeking consistent returns. Not as someone trying to prove how smart they are, but as someone committed to doing what actually works regardless of how it makes them feel. This professional mindset is what ultimately separates those who make trading a profitable career from those who treat it as an expensive hobby. It's what allows some traders to compound their returns steadily over decades, while others blow up their accounts repeatedly despite having access to the same information and opportunities. The difference isn't intelligence or luck or access to secret strategies. The difference is approach. The difference is structure, not just in how they analyze markets, but in how they analyze themselves and manage their own decision-making processes. And this brings us full circle to where we started, the recognition that trading isn't really about markets at all. It's about human behavior, your ability to make rational decisions under uncertainty, your capacity to learn from mistakes without being paralyzed by them, your discipline to follow proven processes even when they feel uncomfortable. The market structure we've been exploring is simply a reflection of collective human behavior operating at massive scale. When you learn to read that structure, you're learning to read human nature itself. When you learn to trade that structure successfully, you're demonstrating mastery over the same psychological forces that challenge every other aspect of human performance. This is why trading skills transfer to other areas of life. The discipline required for risk management applies to financial planning. The patience required for waiting for optimal setups applies to career decisions. The emotional control required for handling losses applies to handling any kind of setback or disappointment. But the reverse is also true. The personal development work you do outside of trading directly impacts your trading performance. The more self-aware you become, the better you'll recognize your own psychological patterns. The more disciplined you become in other areas, the easier it will be to maintain discipline when managing positions. This holistic approach to trading development is what distinguishes long-term successful traders from those who experience temporary success, followed by inevitable failure. Because sustainable success in any challenging field requires not just technical competence, but personal development that supports consistent application of that competence under stress. The market will test every aspect of your character, your patience during slow periods, your discipline during exciting periods, your humility during winning streaks, your resilience during losing streaks, your ability to remain objective when substantial money is at stake. These tests never end because the market never stops presenting new challenges, but each test you pass successfully makes you stronger for the next one. Each lesson you learn from failure makes you wiser for future decisions. Each moment of emotional mastery builds confidence in your ability to handle whatever comes next. You've just witnessed the unveiling of the market's deepest secret, the skeleton that moves beneath every candle, every breakout, every collapse you've ever experienced. This isn't just another trading concept to add to your collection. This is the foundation upon which all market movement rests. The choice before you is simple but profound. Continue trading the shadows on the cave wall or step into the light of structural awareness. You now possess the blueprint that institutions use to systematically extract wealth from those who remain blind to these forces. Your journey to structural mastery begins with a single decision. Open your charts tonight. Find one structural element we've discussed. Document it. Study it. Let this be the moment you stop being the market's victim and start becoming its student. Because the skeleton is always there, always speaking, always revealing the next move to those who've learned its language.